There's a specific reason some people lose $40,000 on a single investment and then go on to do it again. It's not bad luck. It's not the market being unfair. It's a psychological trap so powerful that it has a name, and once you know it exists, you'll start seeing it everywhere, especially in your own wallet. What I'm about to share might make you rethink some of the financial decisions you've made. And the last method, the one that actually works. Something most people never try because the first two feel safer, but they shouldn't. Here's how to protect yourself. In 1999, two psychologists at Cornell University published a study that would change how we understand human intelligence. Dunning-Kruger and David Dunning were trying to explain something strange they kept observing. Why do incompetent people always seem so certain of themselves? They ran a series of experiments, and the results were equal parts hilarious and terrifying. Take the case of MacArthur Wheeler. In 1995, this man walked into a bank in Pittsburgh and robbed it with lemon juice smeared all over his face. Wheeler genuinely believed the lemon juice would make him invisible to the security cameras. He was wrong, and the police caught him within an hour. When Kruger and Dunning studied cases like Wheeler's, they discovered something counterintuitive. It's not that ignorant people lack confidence. It's that ignorance, by its very nature, blinds people to its own existence. They found that incompetent people don't just overestimate themselves slightly. They overestimate themselves by a wide margin. And they are completely unable to see the gap between what they know and what they think they know. The effect had a name, and it would go on to become one of the most studied phenomena in psychology. But here's where it gets expensive. This isn't just a quirky lab experiment. It's playing out right now in brokerage accounts, retirement portfolios, and kitchen table budgets across the country. A 1999 study from the University of Pennsylvania found that 80% of drivers rate themselves as above average drivers. Statistically, that is impossible. Half of all drivers are below average, but almost nobody thinks they're in that half. Now apply that same logic to money. Research from Dalbar Associates, a firm that's been tracking investor behavior since the 1970s, consistently shows that the average equity fund investor earns roughly 4.52% annually over a 20-year period. The S&P 500 index during the same stretch returns closer to 10%. The gap isn't because people pick the wrong stocks. It's because they are victims of their own overconfidence. They sell during panics. They buy during manias. They double down on losers because admitting a loss feels worse than being wrong. That last part has a name too. The sunk cost fallacy. It's when you keep pouring money into something not because it's working, but because you've already invested so much that walking away feels like losing twice. The Dunning-Kruger effect doesn't just make you overconfident. It makes you double down when you should be pulling back. If this is clicking for you, hit subscribe. I drop videos like this every week, and there's a reason I save this next one for last. It's the one that actually changes behavior. Here's the pattern as it shows up in real life. Someone reads 3 articles about Bitcoin and decides they understand cryptocurrency better than most financial advisors. Someone listens to a podcast about real estate and writes a check for a rental property without running a single pro forma. Someone watches a cousin make money on a stock tip and concludes they have a feel for the market. The problem isn't enthusiasm. The problem is that surface-level knowledge in finance feels a lot like expertise. You can open a brokerage account in 4 minutes. You can buy crypto with a credit card. Accessibility creates the illusion of competence. A study published in the Journal of Finance found that overconfident investors trade too much. Their annual returns fall behind the market by roughly 1.5% to 4%. That number sounds small, but over 20 years, the difference between earning 7% and 11% on a $100,000 portfolio is roughly $220,000. Let that sit for a second. Overconfidence didn't just cost someone a bad trade. It cost them $250,000. There's a reason this keeps happening. Financial markets are complex enough that beginners genuinely cannot see how much they don't know. Confirmation bias makes it worse. Once someone decides a stock is a good investment, they seek out reasons it will go up and ignore evidence it won't. The more someone learns, the more their brain finds patterns that confirm what they already believe. This is the dangerous middle ground of the Dunning-Kruger curve. Not the complete beginner who at least knows they don't know anything, and not the expert who has enough knowledge to recognize the limits of their own understanding. The dangerous spot is right here. Someone who has just enough financial literacy to feel confident, but not enough to understand how much is still out of reach. Okay, the solution. 3 specific ways to counter this effect in your own financial life. And the third one is the reason I made this video. First, seek calibrated feedback, not validation. Most people ask questions designed to make them feel better, not get better. Does this investment look okay to you? gets a yes even from cautious advisors. Instead, ask this: what is the strongest argument against this move? That one question reframes the entire conversation. It signals that you want to be corrected, not reassured. Second, pursue genuine expertise instead of surface level knowledge. Reading one book on investing doesn't make you an investor. Real expertise is knowing why you own what you own, understanding the downside of every position in your portfolio, knowing what would make you change your mind, being able to explain a balance sheet to someone who knows nothing about finance and have them walk away understanding your reasoning. That kind of deep knowledge doesn't create overconfidence, it creates humility. Third, and this is the one that most people resist, build a network of advisors who disagree with you, not people who tell you what you want to hear, people who are skilled enough to spot your blind spots and honest enough to tell you about them. The best correction to the Dunning-Kruger effect is not more information. It's being wrong in front of someone who will notice and tell you. That's uncomfortable. It makes most people defensive. And that reaction, the instant defensiveness when someone challenges your financial decision, is actually a signal. It tells you that your ego, not your analysis, is running the show. There's research behind this too. 2006 study in the Journal of Applied Psychology looked at 446 investment decisions across different firms. The teams that actively sought dissenting opinions made better choices than those with homogeneous viewpoints, even when the dissenting voices turned out to be wrong. The process of being challenged sharpened everyone's thinking. Here's what all of this comes down to. The more you learn about money, the more you realize how much you don't know. That sounds like pessimism. It's actually the foundation of making smart financial decisions. The Dunning-Kruger effect doesn't disappear with age or experience. It just changes shape. A veteran investor who has survived 30 years of market cycles still falls prey to overconfidence when a new opportunity feels exciting. A retiree who has managed their own finances for decades still misses blind spots that an objective advisor would catch in 5 minutes. What changes is how you respond to it. The smartest people with money are the ones who approach every decision with a quiet assumption that they might be wrong. They ask the hard question before the decision is made, not after the money is lost. So the next time you feel certain about a financial move, that stock, that property, that business decision, pause. Ask yourself whether that certainty comes from deep expertise or from the kind of surface level knowledge that feels like understanding. If it's the second one, that discomfort you're feeling, that's the Dunning-Kruger effect whispering in your ear. Listen to it. That instinct to stay humble, to ask the hard questions, to find people who will push back. That's what separates a financially smart person from someone who just thinks they are. If this helped you see your own financial patterns more clearly, share it with someone who needs to hear it. And subscribe. I've got something even better coming next week.